Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner.
Thank you, Darryl.
At As Good as Gold. And this morning we interviewed John Adams, Chief Economist at As Good as Gold Australia. Good morning, John.
Good morning, John.
Good morning, Darryl and Brian.
John, it's we keep saying this, but it has been a long time since we interviewed John last. It's been 4 weeks, and a lot's happened. A lot of water flown under the bridge in that period of time. And we'll talk about that in a moment, of course. But what I'd like to point out or highlight is that we've been pretty busy at this end. We had a seminar with John over in Adelaide a few days ago. And guess what? We packed the venue out, didn't we?
We certainly did. We had to knock back 30-odd people.
Oh, it's more than that. We had to knock back about...
You know the numbers better than I.
Yeah, 70 or 80 people. In fact, a week and a half after we advertised, we'd filled up the venue. And so 230 people came along to the event. 70 or 80 missed out. And so we're going to have to do it all over again in a couple of months' time. But it was a raging success. The reviews that have come back from that event have just been outstanding. And we now will continue to do around Australia series of events. So we're going to, John will be speaking in Newcastle in a couple of days' time. And that's once again packed out. We'll be going to Melbourne in about 4 weeks. Then we'll go to Sydney a couple of weeks after that, Brisbane a couple of weeks after that. We've got some other ideas, a couple of other events that where we're being requested to turn up. And so it's all happening. People at the moment, more than ever before, are just keen, desperate to find out how they can stay free in a very dangerous world while Australia sails into the abyss. That's really the discussion, and it's on everyone's lips at the moment. So on top of that, on top of the national tour, we're opening up an office in Melbourne, and so that'll take place within the next month, thereabouts. So we'll be at 257 Collins Street in Melbourne. So we're really looking forward to that. I mean, the business is just opening up for As Good as Gold Australia at the moment.
It certainly
the demand is massive, isn't it?
The demand is incredible, and but we had to put things in place over a big, long period of time, so it didn't become awkward, because we knew as soon as we could go around Australia doing these talks, we knew that everything would be flat out. So Melbourne's the first. Yeah, and Sydney, we got the Sydney seminars, but Sydney will be an office in Sydney probably within 12 months. You never know what we'll do in Perth. You just don't know. But yes, it's all looking good.
I know we've got a really good following in Perth, and John's got a wonderful support base over there as well. So it looks as though Perth will need to look after those guys as well.
Yeah.
So what's happening, as I just said, and economically, there's enormous amount of pressure out there on Australians, as there is all around the world. So, John, it has been 4 weeks since we last interviewed you. If we took a helicopter overview right now, can you highlight how you see the global economic picture?
Like you say, it's been 4 weeks since we last had our last online interview. A lot has happened. A lot of Australians are being, I guess, more concerned with particularly these surging interest rates. And we are seeing inflation still going up around the world. So there was a view a few months ago that inflation had peaked, particularly in the United States. That hasn't happened. And we actually had a very dramatic moment last week at our seminar when I was speaking in the second hour, and you came and whispered in my ear that the American inflation rate had peaked, had gone even higher at 9.1% annualized. when I announced it to the audience, you could hear gasps of air because we were talking a lot about US inflation and the US money supply, etc. So the Americans haven't got inflation under control by any stretch of the imagination. Neither have, say, the British, the Europeans, Japan, etc. So we still have a big inflation problem around the world. Some central banks have, in my view, surrendered to inflation. Japan is not willing to do anything with interest rates, given how indebted the Japanese government is. The Europeans, now here's the thing with the ECB, they've got an official policy rate of negative 0.5% when inflation's at about 8.5%. And so this week coming, in the next few days, they are supposedly going to raise rates by 0.25%. But it is, it is a wimpy little slap in the face when they need to be throwing, a huge punch into the face of inflation. And so, to my mind, they're not serious about fighting inflation, because if they were serious, Italy would be bankrupt within weeks, because these southern European countries have so much debt that they cannot handle the high interest costs that high interest rates from the ECB would actually incur. And one of the things we discussed in the seminar, just to touch on that, Darryl and Brian, for a second, is one of the big reasons why Ireland had the big housing crash in 2008 was because from 2004 to 2007, the European Central Bank doubled interest rates because inflation was going up. So when you did have a debt bubble pre-GFC, and the ECB did respond to that by raising interest rates, it led to the Irish economy crashing. And the debt bubble is way bigger than where we were back then. And the Christine Lagarde and the ECB are very sensitive to these southern European countries crashing, because if they were to crash and you had a huge economic crisis in the south of Italy, I mean, the political fallout from that could be enough to crash the entire Euro project, and the European Union could collapse in a heap, as well as not just the European, in terms of the euro, in terms of the currency, but politically it could collapse. So the European policymakers want to keep Europe together, and that's why they're very focused on financial stability, and that's why they can't. The smart thing to do is to say to the Italians, balance your budget, but obviously the Italian Parliament likes to spend euros like it is in terms of confetti, and the Italian people ask for too many free things, and so you're not going to get the appropriate fiscal reform that you can alleviate the pressure on these government bond markets, and so the Europeans are stuck. And so even though they're going to raise rates in terms of the next few days, it's nowhere near that's what's required. And then when you look at in the United Kingdom, so inflation in the UK is about 9% roughly. And last month they raised the official interest rate from 1% to 1.25%. And again, that's not a serious attempt to bring inflation under control in terms of the UK. So even though you read these media headlines out of the United Kingdom, a Bank of England takes on inflation. I mean, if they're really going to take on inflation, the interest rates need to be above the inflation rate. And so the British need to take their interest rates to 10, 11, 12% at least to give themselves a positive interest rate so they can fight inflation. But if they do that, the British economy will go into a deep recession, and lots of homeowners, given they've got a household debt bubble in England, they would be suffering quite heavily, and they don't want that to occur in the UK. So you have those three areas of the world where they've surrendered to inflation. You have now a number of countries across the world, and particularly last week was very interesting. A number of countries are saying we want to put up a fight. So the Americans are meeting next week. They're expected to raise interest rates by at least 0.75%, taking their official policy rate to 2.5%. Last week we saw the Bank of Canada raise interest rates by 1%. And that sort of shocked the markets, and they went to 2.5%. In terms of New Zealand, they went up by 0.5% to 2.5%. You had South Korea raising interest rates by 0.5%. And the funny thing about South Korea is this is the first time in South Korean economic history did they raise interest rates by 0.5%. So anytime when they've raised interest rates prior, it's only been a small amount, 0.25%, but they went 0.5%, and that was an unprecedented move. And then you had a number of other central banks in Asia do what they call out of cycle. So these were unscheduled rate rises. So Philippines raised interest rates by 0.75%, concerned about rising inflation risk in the Asian region. And then in terms of Singapore is quite interesting in the sense that they conduct monetary policy not by targeting interest rates, but they target the exchange rate. And so they try to keep the Singaporean dollar within a trading range within the US dollar, and then they allow domestic interest rates to float freely. And so again, it was an unscheduled move, but because the US dollar has been particularly strong on expectations of further rate rises by the US Federal Reserve, the Singaporean dollar has fallen in value on a relative basis. And so they decided to announce that they were going to adjust the target range in terms of Singapore, and that they were going to bring the value of the Singaporean dollar up. And so that will obviously mean that the domestic interest rates will go up accordingly. So you are seeing some central banks raise rates, and they say publicly that this is their attempt to fight inflation. Now, like I just said before, if you're going to fight inflation, interest rates have to be above the inflation rate to have a positive real interest rate. And so, taking interest rates to 2.5%, 3%, it sounds good compared to where we were in the last 2 years, but it's nowhere near enough to fight inflation. But on the other hand, given how big this debt bubble is, the more you raise interest rates, the closer you are to something breaking the financial system. And so we're seeing the crypto market collapse. I mean, late in November of 2021, the crypto market was at almost $3 trillion worth of market capitalization. Now it's at about 900 billion. So almost $2 trillion worth of asset value in the crypto market has fallen. And you've seen a number of huge entities in the crypto space go into bankruptcy, and investors have lost of money. We are seeing the bond market, property market, and the share market across the world fall. So investors are losing value, but we haven't seen that big catalyst event that's going to really trigger a global financial crisis. So whether it's a big hedge fund or a big bank, or something out of the blue that really sort of surprises the people, that causes contagion and causes people to in terms of panic in the financial markets. But can I say that if they continue along this path and they keep on raising rates, something will eventually break, and we will have a financial crisis. And the question for policymakers, but investors, and in terms of as good as gold is, will they go all the way and either knowingly and purposely, or even by accident, cause a financial crisis and a potential depression? Or will they realize that they can take interest rates to a certain level, and then they have to stop the depression, to stop the financial crisis, and then they ultimately have to surrender to inflation? So similar to what I've been saying publicly in some of my YouTube interviews with you and others, including Martin North, on the interests of the people, but also in terms of the seminar, my strong view is that all central banks are going to surrender to inflation. No one has the courage to cause a financial crisis and a depression. And that's why, in the context of precious metals, I mean, while we have seen some softening of prices, my strong view is we're going to see a very strong rebound in commodity prices and precious metal prices probably in the next 3 to 6 months.
So are you saying that the policy that we've been watching for many years now of kicking the can further down the road is over? It's come to an end?
So what I'm saying, Darryl, is that the policy that we've seen in, say, the last decade of kicking the can down the road, it's eventually come to a head because all of this has now caused this huge inflation problem. And obviously, the inflation problem of 2021, 2022 was a result of the QE to infinity in 2020, because had they not done that, we would have had a global depression during the time of the pandemic. So 2020 in March, when they announced QE to infinity, that was another kicking can down the road. But that final kick in 2020 has now resulted in a huge inflation problem where official inflation, and again, we've said again on this podcast many times that actual inflation is much higher than the official inflation rate. But over the last decade, from say 2008 to 2020, official inflation around the world was relatively low, 1%, 1.5%, 2%. Now inflation is raging. And now they want to give the appearance that they want to bring this inflation issue under control because of the economic ramifications of out of control inflation. But what I'm saying is that to address it, they have to cause the biggest unmitigated economic disaster in human history. And then they're not. And the reason why I say that is because we've got the biggest debt bubble in the history of economics. So when you look at I think global debt at $305 trillion, if you raise interest rates too high, people are going to default, banks are going to fail, markets are going to crash, and you're going to have mass misery where billions of people are going to be sort of out on the street in mass poverty. And they don't want that to happen because just like, for example, in the last 2 weeks in Sri Lanka, when an economy fully collapses, it's not just that the economy collapses and people are in economic hardship. It results in political chaos and extremism. And we've just had the Sri Lankan president overthrown, the Sri Lankan prime minister forced to resign, and you've got basically a political chaos and revolution in Sri Lanka. And that could happen on a global scale if this debt bubble was to unravel. And so the policymakers who have all the power today, they could easily lose their power either through the ballot box or through armed revolution if they allow this to happen. And that's why I don't think they want to let that political extremism to come out of the box. And so basically in that context, that's why I think they have to appear to be fighting, but in reality, at some point, they'll have to surrender because they don't want to go over the edge. And then at that point of surrender, that's when I think you're going to see everyone talk about stagflation, not only as a potential issue, but as something that is actually happening. Now, I've said stagflation has been happening since 2020. The World Bank is now talking about stagflation as a potential risk. I think it's going to come into the fall over the next 2 years. And we know from the 1970s that when you have stagflation, you see a lot of money going out of traditional assets like bonds and stocks and into commodities, particularly precious metals. And that's why I'm very optimistic about as good as gold, but also the precious metal industry and the mining sector, because I think the economic mismanagement over the last 10 to 20 years is finally going to come to a head, and that's going to be that's going to cause a huge readjustment of capital right across the global financial system.
Yeah, you're dead right there, John. I mean, I've got a couple of questions here in this interview, and we're talking about the price of gold, but that's at a later point in a couple of questions' time. On the subject of Sri Lanka, it wasn't very hard to miss the television reports and the viewing with hundreds of thousands of Sri Lankans marching on their government, Sri Lankans swimming in the palace swimming pools, and enjoying what they could out of the scenario. But I mean, last week, John, you were featured by the Daily Mail Australia over your comments about how Australia is at risk of descending into chaos like Sri Lanka. Now, can you describe what has happened in Sri Lanka and what are the implications for Australia?
In terms of what happened with Sri Lanka, so the Sri Lankan economy in the last few years has grown by a rapid growth of foreign debt. So they borrowed money from around the world, the Americans, Europe, India, China, and that's how they've been able to grow their economy. And over the last few years before the pandemic, there's been concerns by Sri Lanka's creditors that they didn't have enough foreign exchange reserves to meet their foreign debt obligations. So just so our audience understands, every country has its local currency. So we have the Australian dollar, the US has the American dollar, etc. But when you have foreign debt, you know the foreign creditors won't accept your dollars or your currency. They'll accept their currency. So if you borrow in American dollars, or if you borrow in Japanese yen, etc., you need to have enough American dollars and enough Japanese yen to meet those obligations. Now, there was concern that Sri Lanka didn't have enough of reserves to meet their short-term foreign debt obligations, and that's why they got downgraded in 2019 by the international rating agencies, and that decision effectively locked them out of the international credit market. So they going into the pandemic, Sri Lanka was in all sorts of trouble. Now, going into the pandemic, there was two big factors that prevented them from generating more foreign exchange reserves. The first one was there's a collapse in tourism. And generally when tourists come to Sri Lanka, they have their foreign currencies, whether it's Australian dollars, American dollars, whatever. And so when they come to Sri Lanka and they change their foreign currency for the domestic Sri Lankan rupee, well, then the country has more foreign exchange reserves that they can then use that to pay their foreign debt. And then the other thing was that the government actually mandated the prohibition of petroleum-based fertilizer, and there's a couple of theories as to why the government did that. But the result was that without the proper fertilizer, you saw a collapse in the in terms of crops, in terms of crop production in Sri Lanka. So, for example, rice production fell by 50%, and there's also other crops that they didn't grow, wheat, etc. They didn't grow as much as what they did when they were using the proper fertilizer, and so that was a disaster in the sense that in terms of domestic supplies were down. But in terms of Sri Lanka to export their agricultural produce to foreign countries and get those foreign exchange reserves. So, for example, if Sri Lanka was selling rice to, say, the United States, well, they would sell it in American dollars, and they would get those American dollars that they can then use to service their foreign debt. So the collapse of agricultural production and agricultural exports really caused a huge problem in terms of the foreign exchange reserve. Now, on top of that, obviously, we've got global inflation, just like we've been saying. Inflation was picking up from, say, 3-4%. 12 months ago, Sri Lanka inflation was at 6%. By earlier this year, it was at 15%, which is obviously getting in a very dangerous zone. The Sri Lankan currency was fixed against the American dollar. And so when you fix a currency, to maintain that peg, you need to have enough foreign exchange reserves so that you can basically stabilize the foreign exchange price. And so now this year, Sri Lanka needs to pay $7 billion worth of foreign debt back. So the total foreign debt is about, I think, $52 billion. Now, they only had about $1.75 billion of foreign exchange reserves, so they didn't have enough to meet their obligations, and they were rapidly losing these reserves as they were fixing their exchange rate. So on the 9th of March, they were forced to free the currency on the foreign markets, and what happened as a result was the Sri Lankan rupee fell 70%. In terms of its value on the foreign exchange markets, and that obviously, when you have a collapsing currency like that, the result is that inflation goes through the roof. And so, so last month, so they had 15% inflation in March. When we get to June, inflation's at 54%, and the inflation for food. That got as high in terms of it was about 80%. So inflation's gone through the roof. Now, before I talk to the audience about what happened after the currency collapse, just to give an example as what's required to stabilize the currency when it's in free fall, in 2018, 2019, Argentina had inflation raging around 28%. And the peso was falling through the floor, but the Argentina took the decision that it was important to get inflation under control and stabilize the currency. So they raised interest rates to 60%, and they did that within a very quick time frame in order to ensure with their foreign creditors that they were serious about stabilizing the currency. Now, in this case, Sri Lanka decided not to do so. So even though interest rates are at 15%, in order to get the inflation rate under control, they needed to take these interest rates to probably 30-40% at least prior to what I'm about to describe, but they didn't do that. So what ended up happening was they in early April they stated they announced a state of emergency because there was too many protests and riots. They ran out of medicine because once you run low on foreign exchange reserves and you can't borrow any more money, you can't import. And so they're all running out of fuel, they're running out of food, they're running out of medicine. And so then in late April, they announced that they were temporarily stopping payments on their foreign debt. And then when we get to May, they actually came out officially and said we're defaulting in terms of the foreign debt. And so once you say to your creditors, not only am I going to stop paying you, but I'm actually going to default on the debt. Well, with that then further led to the currency going further down to the floor, inflation rising, and basically in a country where the currency has no value, you're running out of food, you don't have enough petrol, and the country's run out of medicine. What sort of living standards can you live? So when we look at June, the 75% of Sri Lankans have had to reduce their food intake because the country is running out of food, and food inflation is going through the roof. And so, and under those circumstances, people had enough, not only of the economic conditions, but confidence in the government, confidence that the Sri Lankan central bank and the president and the prime minister were actually making the appropriate public policy decisions. And so when people are hungry and they're upset and they're frustrated with their living conditions, that resulted in them, tens of thousands of people marching in the presidential palace. And like you said, Brian, I mean, the swimming pool at the presidential palace is fantastic. So hopefully one day, as good as God can send me to Sri Lanka, and I'll go, spend some time at the palace and enjoy myself there. But the president was living well, but now he's been overthrown. Yeah. The Sri Lankan prime minister has been forced to resign. So you have the situation now where you need a new government to stabilize the political situation. Now, the IMF was willing to offer the Sri Lankans a package, but the former Sri Lankan president didn't want to take that package because when the IMF gives you money, there are strings attached, and those strings can be quite hefty, and you have to give up some of your domestic sovereignty. And I think the former president didn't want that to happen, but now they need basically new government to stabilize the country politically. You need a renegotiation of the debt, the foreign debt. You need some additional capital presented from the IMF, some sort of bailout. You've got to basically swallow up whatever conditions the IMF is going to roll out, and you need to stabilize the economy and to grow the economy so that you can generate enough reserves to pay this foreign debt, and you need to stabilize the currency. So Sri Lanka is in all sorts of trouble. And a lot of it is due to excessive foreign debt, not enough foreign exchange reserves, and creditors losing confidence in their ability to repay their debts. Now, how does that translate to Australia? Australia has huge foreign debt. In gross terms, 2.5 trillion. In net terms of about 1.2 trillion. Relative to GDP, about 50%. I've been very worried about the foreign debt for a number of years. So has some other economists who have been warning about the potential situation like Sri Lanka happening here in Australia. And so we probably have a few steps to go. I mean, we have been downgraded by the international credit rating agencies, but we do potentially have a shortfall in terms of our 1 year foreign debt obligations. We're probably short about $250 billion. And so if it comes into a situation where we have issues with our trading relationships, we're not able to generate enough foreign exchange reserves, either through mining or through education or tourism, we could well enter a situation. And we actually had this situation in 1985, 1986 under the Hawke government, where our foreign creditors, they become concerned with our management of the economy, our ability to service the foreign debt, and we could see the current account deficit run out of control, pressure on the Australian dollar as well. and then you get into a situation of you either have to dramatically raise interest rates to stabilize the dollar. Otherwise, if you let the currency go, you could have a huge inflation problem. So all the ingredients for Australia are there for us to descend into a Sri Lankan type of chaos situation. Now, while we have a few steps to go, policymakers, but also the Australian people have to realise that the living standards that we live in Australia today is not because we generate sufficient income to pay for it. We've been, using the international credit card for at least 30 to 35 years, and we've run up huge debts to live a great lifestyle during this time. But at some point, the chickens come home to roost, and so we've got to be very careful about ensuring that our foreign creditors know that we're good for the money. Because if they get a sniff that we're not good for the money, or we're going to devalue the Australian dollar so that that we're not going to manage our foreign exchange rate properly, well, then we could see the Sri Lankan episode happen here in Australia, and that would be catastrophic if that were to occur.
Well, I got 2 points after that explanation, which was a fantastic explanation of what the problem is in Sri Lanka. You brought up the International Monetary Fund. It was interesting that our last call, Darryl, to Gerald Celente, he didn't call it the International Monetary Fund. He called it the International Mafia Fund. And I think he's a lot closer to the mark, because I have never seen any country that has actually dealt with the IMF come out on a good position.
No.
So the International Mafia Fund is starting to starting to wave its hand again. And look, the other thing is too, and maybe I'll leave it to the gold when I talk about the gold standard. So Darryl, maybe you carry on first.
Yeah. Okay. Look, John, in the last 3 months, we've seen the RBA raise interest rates on 3 occasions, from 0.1% to 1.35. The Commonwealth Bank is now forecasting 0.5% in August, September, respectively. Can you give an overview of Australia's monetary policy, and what are the implications if we move ahead with these interest rate movements?
One of our key messages at our seminar last week in Adelaide was that, technically speaking, the property market in Adelaide is still going up, but it is slowing down dramatically. Whereas in Sydney and Melbourne, the property market is falling, and the property market in Sydney started falling in February, and those falls are starting to become more aggressive. And so you had a whole host of people borrowing extraordinary sums of money, particularly in the last 2 years. In some cases at 2%, 1.8, 1.9%. And now if you want a fixed mortgage at 3 years, you're looking at 6.5%. But even if you're looking at, for example, Commonwealth Bank, standard variable mortgage rate, 5.8. So these interest rates have already doubled, in some cases already tripled. And 60% of the property market is variable interest, 40% is fixed. And a lot of those fixed mortgages will come off between July in December in terms of next year. So a lot of people going through pain, and that pain is going to intensify. Now, the RBA, I think, is driven by 2 big considerations. One is that their public statement is that they want to get domestic inflation under control. And even though they promised that interest rates wouldn't raise and go up until 2024, they misunderstood the inflation dynamics in the global and domestic economy. And now with inflation going up quite aggressively, and inflation, I should say, inflation was going to go up well before the Ukraine war. So anyone who says this is a result of the actions of the Kremlin, that's not an accurate picture. And so they're now forced to raise interest rates, and this is the most aggressive interest rate tightening campaign since 1994. A lot of households were not prepared for in terms of this occurrence. And when we look at how aggressive some of these foreign central banks are going, I mean, we are perhaps one of the most aggressive in the world, and we obviously haven't stopped. Now, so in domestic inflation is one aspect, but also as we start to think about how does this Sri Lankan situation manifest itself here in Australia. Well, if you look at, for example, New Zealand last week took their official interest rate to 2.5%. Same with Canada. Next week, America will go from 1.75 to 2.5%, and we're still lagging at 0.35. So if we're going to maintain the value of the Australian dollar, particularly against the Americans, we are behind the we're behind the bell curve, and we potentially need to become more aggressive to keep that dollar in check. Because one of the big considerations with the value of the dollar, the Australian dollar versus the US dollar, is the official interest rate differential. So we don't want that that interest rate to be too far away from the Americans. So for that reason, that's why even though the Commonwealth Bank is forecasting 0.5% in August and 0.5% in September, Deutsche Bank came out last week saying that the RBA will be forced to raise interest rates by 0.75 on the 2nd of August. So this foreign debt problem, coupled with the value of the Australian dollar versus the Americas, this is another sort of sleeping issue which the mainstream media and the RBA really haven't talked about, but I think it is a important consideration. So when you have a foreign debt situation like we have, we're not the masters of our own destiny. We're not the masters of our own destiny. We're also contingent on what other central banks and other policymakers do around the world, and we have to respond in kind because of how reliant we are on foreign capital. And so because of that, we are definitely going to see, at least in the next 2 months, aggressive interest rate rises. That's going to have a huge impact for those that have got large debts, particularly on the East Coast, Sydney and Melbourne. And what we're going to see is we're going to start to see a whole host of people across Australia start to tighten their belts around in terms of consumption, particularly discretionary consumption. So the things that people want as opposed to the things that people need. And then you're going to start to see, well, we're already seeing the building sector in all sorts of trouble right across the east coast of Australia. The building sector has already basically called out and said these rate rises are too aggressive. The RBA needs to slow down. The banks are already pushing different ideas about that they don't want property prices to fall too hard, otherwise that's going to cause a problem for the banks. The property sector is now asking for 40-year mortgages because they're concerned that the property sector is going to collapse. And so because we have the biggest domestic debt bubble, particularly in households, ever since the European settlement in 1788, the RBA they don't have a real-time understanding as to how many of these interest rate rises can households take before you're going to see a huge amount of defaults. But we're going to see a lot of pain come through the system in the next 8 weeks, and so we're probably going to see at least 5 months. So if we think about May, June, July, August, September, very aggressive rate rises in the midst of the lowest interest rates in Australian history, when you've got the biggest domestic debt bubble since 1788. For those households that are in that situation, it is going to be extremely painful. And I dare I say we're going to see a lot of defaults starting to come through the system. So now what happens after we get through September? I think it's going to be a contingent on what we see around the world with the international monetary policy settings, but also in terms of whether how households respond to these interest rate rises. And the RBA has already said on the record they're not sure. They're very uncertain as to how households will respond. So I think you're going to start to see some dramatic changes in the Australian economy going into the spring season. And can I say, when it comes to property, so as these rate rises go up, that means borrowers can borrow less because their borrowing capacity that basically reduces. So when borrowers are spooked, they can borrow less, and then you go into the spring season where you've got a whole bunch of sellers under financial pressure, and they're going to dump their property on the market. There's already people in the property sector in Sydney saying that the stock of property in the spring season, so September, October, could be double or triple where we are today, and you're going to have less buyers with people being able to borrow less amount of money. That's going to be you're going to see a whole bunch of sellers that will be forced to cut their prices dramatically. And what I can say now, given that we're in mid-July, some of these vendors in Sydney are losing literally hundreds of thousands of dollars per week. So these properties, I've seen numerous examples where someone wants $2 million for a property. They have to maybe settle for 1.6 in order to get the sale. And I've seen $3 million properties go for 2.5. So there's all sorts of people that have expectations as to what's the value of their portfolio, what sort of price do they want to get in the market in order to settle their existing debts, and in terms of planning their financial future. You're going to see all sorts of people be very upset because they're going to be taking prices much lower than what they would hope for, and whether they can get themselves out of the financial hole that they can, we'll have to wait and see. But I think for quite a few people, particularly in Sydney, it's going to be a complete disaster. And unfortunately, Darryl, Brian, I mean, part of what I wanted to achieve with Martin North and as with As Good as Gold Australia was to warn Australians not to get themselves into this situation. So when the situation does arise, we could minimise the harm. But we've been able to help thousands of Australians that have heard, who have been open-minded to hear our message. But for those that either didn't know us or didn't want to listen to what we had to say, a number of those people are going to really hit the wall in the next few months. And the real question then becomes is when the pain becomes too much. What does, not only the RBA, but what does other central banks do? Do they continue pushing the pain in order to get inflation back to 2 to 3%? Or do they say that the pain is too much for Australian households to go through and the property sector and the banking system, and that we have to surrender to inflation? So, there is some voices out there saying that inflation will come down, but inflation is going to won't be back at 2 to 3%. It'll probably be ranging around 4 to 5%, because in order to get inflation down to 2 to 3%, the pain, the economic pain, the political pain, the social pain among households, the implications for the property sector and the banks is too much to handle. And that's where this really, this choice of, do we go off the edge of the world? Do we go into the abyss? We're quickly getting to that point, and it's going to be fascinating to see what policymakers do in that situation.
You paint a very bleak picture, John. But look, quite clearly, this is not going to be a soft landing. There is no easy way out of this predicament. And it's what tends to happen when you have this policy of constantly, and this has been going on for years, kicking the can further down the road. No governments, no central banks prepared to tell the truth, tell us the predicament we're in. And they've just continued to try and hide what's really happening, hide it away from all of us until we reach a point where we're between a rock and a hard place. And John has described quite clearly what Australians have to prepare for. And this is, of course, coming up in the events. They're a must-attend event all around Australia. John will be talking in depth about what he has briefly spoken about in this interview today. But no, it's seriously difficult times ahead.
Absolutely, and this is what I'm so dead against when politicians and prime ministers of your country and central banks also as well consider that the price of your home, if it goes up in price, it makes you feel more wealthier. Well, I've only ever known wealth is real wealth coming from production. Just because they put an extra digit, an extra zero on a home price doesn't mean you're wealthy. What it means is somebody's borrowed a hell of a lot more money, right? And that's pushed up the prices. So, I've got a question here for you, John, with reference to the price of gold and silver. Before I actually ask the question, I'm just going to read an article that I came across from Stephen Lieb. He's an author out of the United States. And he says, eventually, gold is going to take its place. But right now, because gold has such a special position in the world as both commodity and foremost currency, and major rival to the dollar, you can bet that when you start seeing the end of dollar hegemony, the US is going to pull out all the stops. Every stop in the book that you can name is being used to suppress the price of gold. That's the only thing the West can do, is suppress the price of gold. Now, it's not going to work. The aftermath is going to be a bull market that really defines what off the charts really mean. This takedown is the last desperate effort that the West is trying, and it just won't work. Everybody's talking about the price of gold and silver gone down in the last few months. In my personal opinion, Darryl and I buy more.
We buy more.
We buy more, because it's going down in price. Why would you do anything else? But for those who haven't been unable to buy more, you might have to tighten the belt a little bit, because at the end of the day, right, if you have gold and silver, right, in your possession, you're going to be far better off than cash in the bank. Now, the price of gold and silver has come down since April, John, and this has caused concern among some investors, not with us, but some. Can you explain what is driving prices at the moment, and why you are confident that the price of gold and silver is likely to recover in the near future?
What a lot of, particularly in the context of the price of gold, a lot of some of the overseas friends and analysts that we have, what they've been able to find, for example, is saying in the context of the United States, you see a very nice relationship between negative interest rates and the price of gold. So what is a negative interest rate? It's when the inflation rate is above the interest rate. So that's what your negative real interest rate is. And when that goes larger, the price of gold tends to respond and goes up. And when that gets smaller, it tends to go in the reverse direction. And so in this environment where you see the US Federal Reserve aggressively raising rates, particularly against some of the other central banks that are not, you're seeing the US dollar surge up. And so, obviously, institutional funds in particular, and the big funds that really sort of determine where the big capital flows go in the financial markets, they're going into the US dollar and not going into gold and silver. And so when you're seeing rising rates, smaller negative real interest rates, people are going to the dollar, not to gold and silver. And so we've seen commodity prices across the board fall, and obviously, oil's come off, gas has come off, perhaps not as much, but then you've obviously like lumber and a whole bunch of other sort of commodities that were quite strong in 2021 come off the boil quite a bit. And so in that environment, gold and silver is going down in price. Now, I would say two things. One is that once you start to see a change in this relationship in terms of inflation and interest rates, so if you see, and it doesn't necessarily have to be an interest rate cut, Brian, as long as the US Federal Reserve in particular, if they say we're slowing down our rate rises, or we're going to stop because we're not going to push the economy into a depression, that pause is going to basically wake up these institutional funds to say that from here on in, the dollar is going to get weaker because they're not going to continue to raise rates. And then you're going to see a readjustment of capital flows away from the dollar back into commodities, and you're going to very likely see in terms of gold and silver going up. Now, I was just actually on another interview today where people actually asked me to explain the differences between the stock market versus gold and silver. And so one of the interesting aspects of stagflation is that you have weak economic growth. At the same time, you've got prices too high because of out of control money printing. And so when they decide to pause interest rates, and also when interest rates start to come down, and they try to reflate the bubble through more stimulus, the question then becomes is, where does this new stimulus go? Does it go back into the stock market? Does it go into cryptos? Does it go into commodities? Does it go into precious metals? Now, one of the big questions that investors will have to ask themselves is that if you want to reinvest into general equities, so shares related to banks, retail, manufacturing, etc., how does rising stock prices justify itself? It's through corporations generating more profit and that profit growth is quite healthy. But when you have an economy that has weak growth, that has stagnation, what it means for corporate profits in general is that the profit growth is going to be quite weak. So if you've got a weak economy, your appetite or your forward expectations on profits for these corporates are going to be low. At the same time, you've got inflation high. In context, and this is what we saw in the 70s, people thought to themselves they're going to preserve their wealth better by investing in by buying physical gold and silver, but also buying in gold and silver mining shares, compared to buying general businesses, because these businesses are not performing particularly well. And so that's going to be one of the big questions that investors will have to ask themselves is, well, if you get the more stimulus, do I go into commodities? Do I go into gold and silver? Do I reinvest in financial institutions like banks? Do I go back into cryptocurrencies, or do I go into retail, manufacturing, property stocks, etc.? And just to give you a sense, shares on the Australian Stock Exchange related to the property sector have gone through the floor ever since the RBA has raised rates. And so in this forward environment where economic growth is going to be relatively weak, and corporate earnings is going to be weak as well, that's why I think we're going to see a big shift away from general equities into commodities, into precious metals, and the quote that you stated, Ryan, about we're going to see a rocketing escalation of prices. I think that's going. I think it's very likely that's going to happen once we see, particularly the U.S. Federal Reserve, pause their interest rate tightening campaign because they don't want to cause a financial crisis. And so that's. That scenario is why I remain invested in gold and silver, and obviously I continue my relationship with As Good as Gold Australia as well. The other thing I would point to is that, particularly if you look at the COMEX data, so I look at the COMEX data on a daily basis, particularly in terms of the amount of gold and silver that they're holding in their warehouses. We're seeing a strong draining of gold ounces out of the COMEX, and that's obviously a very positive and big sign that someone is out there buying gold and taking delivery from the COMEX. The other thing I would say is that if any Australian can do this, if you every Saturday during the day, just go onto the CFTC website, so the Commodity Future Trading Commission website, which is the American regulator. You can download the weekly futures, what they call the Commitment of Trader reports. And so I've been collecting these reports for quite a while, particularly around silver. And what you're seeing is that these swap dealers, which some say are the banks are actually forecasting that prices will go up, and that's why they are net long in terms of their future positions, future trading positions, whereas the hedge funds, the speculators, think that the prices are going down. And so a number of analysts who have been looking at this for 2 or 3 decades have said that the best predictor of price when you're looking at these Commitment of Trader reports is, what are the banks doing? And the banks are basically positioning themselves for higher prices. Whereas the hedge funds and what they call the managed money, these speculators are thinking that the prices are going to go down. And so these bullion banks have typically always been right in their forecast of price. And so when I look at the technical data in terms of how much gold and silver is being held at the COMEX, and I'm seeing that gold's being drained at a pretty aggressive rate, and I see these Commitment of Trade reports where the banks are basically positioning themselves for higher gold and silver prices, I think we're going to see a rebound in terms of from the current price of where we are today, both in Australian and US dollars, and then obviously once we start to see the change in monetary policy, where we see the expected pivot that I think is coming, all those are going to see another bull market run in precious metals, and like I said, prices are down, great time to buy, and I continue to buy where I have the ability to be able to do so. Both of you have just said that while prices are down, you're buying as well, and yeah, so I think once you consider the macroeconomic picture and some of the technical data, and obviously when we look at the 5,000-year history of gold and silver, it sounds like a very good time to be able to commit capital into physical bullion.
Well, thanks, John. And as you know, audience, I always put a comment on any of the people that we interview. And Darryl, for the life of me, I cannot understand why people, or why audiences, clients obviously starting to get the picture. Darryl and I have been buying gold and silver since 1997. It's 25 years ago. Yeah, we've had some ups and downs, but when you have a look at our graph, it just goes up at 45 degrees, and you have these little pivot points, right? We don't take too much notice of a pivot point. We just buy more, and the proof is that we bought gold at $400 or slightly less 25 years ago. Now, in Australian dollars, it's 2,600, 2,700. We're not worried about a pivot point. The other thing that really gets up my goat is the fact that people have more faith in the US dollar, or the Australian dollar for that fact, but the US dollar, the world's reserve currency. For God's sake, it's a piece of paper. The government of the United States has $30 trillion in debt. Why would any piece of paper be worth anything when you're $30 trillion in debt? And the other point is the whole thing, if they want to print more, which causes inflation anyway, printing more money means that the extra money, which requires an interest rate on it. So the bottom line is, doesn't matter how many times they print, the interest rate is added to it. And therefore they've got to print until the whole thing collapses. Guys, we must look at this whole picture and come to the conclusion that a gold standard, and I'm 100% believer in a gold standard will rectify all these problems that we have today. Darryl?
Yeah, I agree with everything Brian said. And what I keep saying is that the gold price confirms the absolute mismanagement of governments and their economic policies all around the world. If I can repeat that, gold price confirms the government's absolute mismanagement of the economy and fiat currencies. How do we know that? When you compare it to gold, gold was $35 an ounce and now it's $2,700, right? So interestingly enough, see, the higher that gold goes up in value, the worse it confirms that of the mismanagement of the government. So no wonder there is suppression. No wonder they want to suppress gold. Gold is the government's and the central bank's arch enemy. They like it for themselves, but they don't want you to have any of it. Because what gives them power, they don't want to, in fact, provide you with the same amount of power. Interesting, isn't it?
Isn't it? I mean, it's amazing how J.P. Morgan 100 years ago said in Parliament, he said, gold is money, everything else is credit. Right? I mean, we're not hoarding gold. We just don't believe there's another business or asset out there that's worth the money that they're asking for. But gold is money. I will continue to use it as money, but when the time is right.
So you can suppress it for a while, but typical of the GFC, when you had about 0.8 of 1% of the Western world's population invested in gold, and at the end of the year, that was prior GFC, 2007-8, 2011, it was close to 7.8%. So when you have a lot more of the population investing in precious metals, investing in gold, there isn't a suppression in the world. There's no entity that can impact on gold and keep it down. It's impossible.
That's correct.
And it just goes to the level where it needs to be. Talking gold, we have a 1 ounce gold coin that we'd like to just confirm that is now available. It's the Freedom coin. As you all know, we've had a silver 1 ounce silver round. Now we've got the 1 ounce gold coins, Freedom coin. Freedom is only acquired through the constant pursuit and unrelenting struggle to reach it. Keep in mind, freedom does not come free. You have to work hard for it. It's an unrelenting struggle. You've got to prepare for it. And that's exactly what John's been talking about through this full interview. Jim Sinclair has said many, many times, become your own central bank. In particular, in economic times in the type of economic times we're experiencing right now. Peter Daniels, I do not care what poorly executed economic decisions are made in the world tonight, because tomorrow I'll still be able to party. Why? Because he has gold. It's as simple as that. He's prepared economically. You've got to have reserves. And Brian, Egon von Greyer's, of course, Egon talks about, when asked the question, how much should you invest in gold or in precious metals, he says,
oh, it's a very simple answer. You know, what you invest in gold is whatever you can't afford to lose in any of your other investments.
Yeah. Ray Dalio, $18.4 billion net assets. Ray Dalio says, everyone should consider a 5 to 10% allocation to gold as a hedge. If you have an excellent analysis as to why you shouldn't have such an allocation to gold, we'd appreciate you sharing it with us. Powerful words, and I don't think that he's ever lost a debate on that subject yet.
Yeah, and at the end of the day, 10% allocation is for those who are the top investors of the world. If you're not a top investor of the world, I'd probably up the allocation a bit.
Interestingly enough, Brian, he says 5 to 10%, 18.4 billion, 10% would be 1.8 billion
in
with
gold.
a B in gold. Yeah. Hey, John, thank you so much once again. Huge presentation today, enormous value, and it gives some indication as what people could expect at an event when you are the keynote speaker. You'll expand on a lot of the things that you discussed today because we've got more time to do so. And everybody suggested, and the reviews that came back said it was worth 10 times what we paid to go, and see that event. So congratulations, John. You did a fantastic job, and we're looking forward to working with you over the next 2 or 3 months while we tour Australia and present our case to the Australian populace at large. Thank you also to our viewers and subscribers who continue to support this channel. We appreciate you doing that. And all I can say now is until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.
The only thing I'll say I'm disappointed of when Darryl said gold is the greatest enemy of government. I thought I would be the more great enemy of the